Good morning. I'd like to give a warm welcome to everyone tuning into today's BizTax session. Our topic today is navigating a protectionist Canada-U.S. landscape with some cross-border tax insights. My name is Namir Hallak. I'm a partner in tax at Andersen here in beautiful Vancouver, and I'm joined by my colleague from our Calgary office, Atif Mir. Atif?
Thank you, Namir. I work in Calgary office, as Namir said, in Andersen. I deal with the Canadian tax, international corporate and domestic Canadian tax, and I'm looking forward to the presentation.
All right, so I guess some quick housekeeping items. As a NASBA accredited sponsor, we are able to offer continuing professional education CPE credits for today's webinar. In order to qualify, you'll need to answer all 3 polling questions. We actually have 4 today. That'll appear during the session. They will pop up at various times throughout the webinar, so pay attention and stay tuned and respond promptly to each one. With the questions, we do encourage you throughout the session, if you have any, ask them in the webinar using the Q&A function. While we may not be able to address them immediately, we do have some time set aside at the end of the session to go through as many as we can. We really do welcome your engagement. When the webinar ends, we will have a short survey, and that'll automatically pop up. We would greatly appreciate if you could take a moment and complete it. We actually do look at the feedback. It helps us improve future webinars and to continue to bring you relevant, valuable content to your desktop or laptop or phone. There's also on the very bottom there, you see something that says CC. That is for a live transcript option. So if you'd like to enable closed captioning, just simply click on the live transcript button at the bottom of your Zoom window and select Show Subtitle. This could be helpful if you're in a noisy environment or just prefer to follow along with text. All right, so what's on the agenda today? We're going to navigate through the protectionist U.S.-Canada landscape. And we're going to go on this journey by traversing through those 4 agenda topics. We're going to start off with a tariffs update, hot topic of the day. Where do we stand today? Of course, with a focus on U.S. and Canada. And then we're going to go into U.S. tax and policy shift. And there's been a major update that happened yesterday. So it's for those of us who are closely watching U.S. tax, what does that mean for you? And then our third stop will be looking at some significant changes on the Canadian tax front, as Atif will lead us through that. And then we're going to wrap up our journey through and across this landscape by discussing planning opportunities and strategies for cross-border businesses and owners. Let's start out with tariffs. So what is the latest with tariffs? And, specifically, what's happening between the US and Canada right now? So, earlier this year, the US rolled out, a new round of tariffs, 25% on many imports and 10% on many energy-related products. And, after a few rounds, there was some speculation about whether or not Canada would be spared. And that's not necessarily how this has played out. And we feel it. We're feeling your concerns. We have our clients, and Canadian businesses are definitely feeling the impact. And we're hearing from a lot of our clients, it's pretty consistent. And mostly it's that the uncertainty does feel, pretty chaotic. And part of the uncertainty there is, how do you apply these rules? And what we've been seeing is that this uncertainty is leading to delays or some confusion and, of course, extra costs. And of course, you might be thinking, well, we've got CUSMA, right? CUSMA is the the new name for the Canada-U.S.-Mexico Trade Agreement, or NAFTA. How does that protect us? And actually, it does, but only if your goods are properly documented. And that's the key. If you haven't reviewed your rules of origin paperwork today, now is the time to do it. It's really, no longer optional. And another thing we're seeing, and we're doing with a lot of our clients today in navigating this, again, protectionist environment and these tariffs, is what we call tariff engineering. And really what that's about, it's rethinking, how is a product being built or how is it being labeled to hopefully help them land in what is a lower tariff category. So, for example, I have that, mug that I put on there. So if you have like, for example, a ceramic mug, and it's imported with a printed design, that might face a higher duty than the same plain mug that was imported without any, design on it. So, companies are starting to have to choose, okay, do I need to decorate the products after we import them to save on tariffs? It's a legal process, but these little considerations and these type of costs that you think about when you're bringing your product from Canada to the USA really does matter. And another strategy that's been garnering more attention again in this US-Canada protectionist landscape that we're in is what's known as US foreign trade zones, or FTZs. And these are essentially specially designated areas where goods can be imported or they can be stored or even processed without triggering, duties or tariffs when they enter that zone. So essentially what happens there is you're really only paying when the product leaves the zone and enters the US market. So if you're distributing or manufacturing in the US, this could be a smart move to help you defer or reduce those duties. If the goods are then re-exported, then essentially really what we're saying here is no US duties are paid on those products. Another consideration with the FTZs is, if you have, for example, raw material with higher tariffs than the actual finished goods, you can pay the lower rate by essentially assembling them in the FTZs and still get access to the US market. And I think that's, part of the consideration for a lot of Canadian businesses and business owners is, they really still want to be able to tap into the US market. It's a significant market for us Canadians. It's understanding what is the right way to do it, what is the efficient way to do it. And so, of course, we're talking about FTZs, we're talking about tariff engineering. But, the other big question that's been, knocking on our doors as, cross-border tax advisors is, hey, Namir, hey, Atif, is this the right time to set up, for example, a US subsidiary? Is this the right time to have the, made in USA marker on our product? And look, for some, the answer could be yes. It's really, there's an opportunity there to, open the door to, local, state tax incentives, or even on a more granular jurisdiction. It could, of course, simplify logistics and give you access to programs like this, foreign trade zones and or other state level grants. But I'll be honest with you, a lot of the conversation we're having with Canadian business owners is, take a step back still and ensure that, if this is one of your next steps in your overall cross-border expansion plan, hopefully it's not one that is, reactionary just to the day-to-day news. It needs to be part of a strategic long-term plan for where the business wants to go, where you see your market going, and what the business owner's exit plan is, in the longer term. But, again, if you've been on the fence about US expansion, the tariffs for a lot of businesses that we're talking to, a lot of business owners, tariffs might just be that push that, it does tip the scale. The other thing that you may have heard a lot of buzz about that change in terms of tariffs was the $800 de minimis rule. As it stands right now for Mexico and Canada, it allows you this $800 de minimis rule to ship goods under $800 to the US customers without triggering duties. That rule, it is under review, so it may not last much longer. And just to give you a sense of how volatile things have been, although I'm sure you're probably aware as in the last couple months with tariffs, for example, with Canadian softwood lumber, it's currently facing a 14.5% US tariff. There was fear with the 25% general tariff that was initially being discussed that, if you slap those two on together, we're talking about a 39.5% in March tariffs for Canadian softwood lumber. But thankfully, a lot of industry lobbying has exempted this increase. So there is this, we're not completely out of the woods, not for the use of a bad pun there, but that could still rise to 27% or more by the end of the year. And then, of course, for our friends in Ontario, the auto sector, it hasn't been hit yet, but it is still under the microscope, especially with, the EV, electrical vehicle supply chains in focus. I would say just from a U.S. lens on tariffs here for our Canadian businesses and Canadian business owners, don't sit back. This is the time, if you've already been doing business in the U.S., you do want to tap into the U.S. market. This is the time to really review your supply chain. Look at your documentation. Consider if there's opportunities there for the tariff engineering. Look at your tax structure. If the tax structure has been around for years, this may be a time to revisit it, as long as, again, it's aligning with your business and operational goals. My recommendation for the business owners is this is the time to adapt early and really position yourself as best as possible. So, you're staying compliant and hopefully protecting your margins here back in Canada.
Thank you, Namir. That was a wonderful introduction. And as Namir pointed out, there are a lot of things happening with tariff. There's a lot of challenges, there are a lot of opportunities, but keep your eyes on the goal, focus on the strategic long-term objectives, try to stick to them, don't be reactionary. However, at the end of the day, tariffs will pass. Things will settle down into some sort of an equilibrium. Markets will adjust. Hopefully, there will be a better deal on tariffs as well. But while some businesses might adapt quickly, might find opportunities in the challenges posed by tariff, there might be some businesses which might struggle. And some businesses who depend so heavily on the U.S. U.S. market that they will have to go through a lot of steps to be able to leverage the other free trade agreements that have been in place and that Canadian government has been negotiating as well. So the European free trade with the European Union came into effect in, I believe, 7 years ago, but it's highly under leveraged. So that is something to keep in mind. There are opportunities out there. Keep your eyes on the strategic goals. But at the same time, while you're going through the adjustment, the Canadian government has offered some help. There were talks of personal and corporate taxes in the election platform, but nothing concrete yet has come out. Would they reduce the tax or adjust the taxes to improve the margins? We don't know yet. And then there's other government assistance that is being offered to the businesses. So for example, when the early wave of tariffs came in March from the United States and Canada responded with their own tariffs, the Canadian government did say that there will be a remission of Canadian tariffs on US goods to address situations where the goods cannot be sourced domestically or outside the US. So you will have some break there if you are depending on the goods that can only be brought from the US. And then there are some exceptional circumstances, case by case basis, that the government will consider to figure out if the remission or some sort of relief is available to Canadian businesses while they adjust to the new realities. And then later, when the auto tariffs kicked in on the US side, Canadian government also got active and responded with its own tariffs, but it also at the same time offered some relief. It said that if you produce certain number of cars, if you keep the production local, then you can import certain cars from the USA tariff-free, because some Canadian auto companies or dealers, they need to import the certain brands of car from the US because those cars are not built in Canada. But the Canadian government said, okay, you can do that, but you cannot reduce your Canadian auto production as a result of the tariff. And they also came up with this idea that if there's an insolvency risk because of tariff, and I emphasize because of tariff, then you can ask for some sort of a loan facility. And there are reliefs available, there are opportunities, and there are some reliefs to help the Canadian businesses to navigate the challenges posed by the tariffs.
Thanks, Sarah. Thanks to there, Atif. All right. So what I want to go next into what's happening on the U.S. tax and policy shifts, which is tied into the tariffs discussion and what businesses both in US and Canada and owners and individuals need to be considering. So before I get into what's changing, I want to start by the question of, why now? Or even, how did we get here? Why are we talking about changes? Well, to give context, back in 2017, the United States passed what's known as the Tax Cuts and Jobs Act, TCJA. And this was a pretty, sweeping overhaul of the tax code. It had some pretty big changes. Many of its provisions, a lot of the provisions that were in that Tax Cuts and Jobs Act, though, were temporary. So a lot of them were set to sunset. A lot of them were seeing them sunset or expire or reduce in terms of the benefits that they have in 2025, this year. So, we're staring down at the end of 2025, and when a lot of these provisions are set to expire. And the reason for that, by the way, the reason these are temporary and they're set to expire is that was partly a budget move, right? It's to make the numbers work under the reconciliation rules. And I'll talk a little bit about that here in a bit. What is the budgeted rules and why does that matter? So in the US, from a political standpoint, the legislators are really facing an interesting challenge, right? They have to look at these temporary provisions and they have to decide, which of these provisions do we want to extend? Which of them do we want to repeal or modify? And you've got this really powerful committee, the House Ways and Means Committee in the House of Representatives, and they've been deep in these discussions, right? And their goal is, how do we avoid what is essentially a multi-trillion-dollar tax hike on Americans if they do nothing? So let's walk through some of those key provisions. What's on the table, what's about to expire, and what does that mean for businesses and investors that have a US presence? The first one I want to talk about is what's known as a QBI deduction, or this is essentially a 20% pass-through deduction, and it's available for a pass-through entity. So pass-through entities could be, a partnership, it could be sole proprietorship, it could also be certain LLCs. And, if Congress does nothing about this provision, it means that those pass-through entities will lose that 20% deduction. It means it will expire at the end of 2025. So, one of the recommendations we're asking clients who do have pass-through entities in their structure is model this out. Model out what the tax changes look like, whether you have a pass-through entity or you have a corporation. So model out what it means to potentially lose this 20% deduction. Will that, give some validation to a different type of structure for you? The other temporary provision is around business interest deductions. So the rules around this have gotten tighter, and businesses are not very happy with this, especially, if they've been pretty well leveraged. And what this is businesses can only deduct, 30% of their adjusted taxable income. And again, the way this has sunset since 2017 is that restriction has become even more limited. And that's because since 2022, the restriction on how much business interest you can deduct has gone to EBIT, so earnings before interest and taxes. Whereas when this was initially legislated, it was EBITDA, so includes depreciation and amortization. So it's a more severe limitation and makes the cap even more stricter for businesses to be able to deduct interest expense. So there's a lot of talk about rolling that back, and we'll get into that in a second. The other one that's a major provision that's expiring that has businesses, anxious is around what's known as bonus depreciation. It's another big one. And what this is from 2017, again, when the TCJA was enacted, all the way till 2022, businesses could essentially expense 100% of their qualifying capital investments. That's great, right? If you're a business that has pretty heavy investments in capital, that's a big one for you. That's 100% expensing from 2017 to 2022. But this has started to phase out. It has already started to sunset. So in 2023, that's gone down to 80%. In 2024, it's 60%. This year, it's 40%. And again, if Congress does nothing and says we're not going to touch this, by 2027, this is completely gone. So what that means is if you are doing those type of capital purchases, you're going to have to recover it over the life of the asset and not get the immediate 100% expensing. Now, on the international side, we had a couple of provisions that also were issued with the TCJA. One of them is GILTI, which is a tax for U.S. shareholders on their foreign non-US earnings. So after 2025, the effective GILTI rate for US shareholders is set to go up. And what that means, again, if Congress decides they don't want to do anything to change this, it means that, for a US company or a US shareholder, they might rethink their global structures. Do they want to expand in Canada? Do they really want to keep their profits offshore, outside of the US, knowing that the GILTI rate, the rate on their foreign earnings, will go up if if the rate goes up in 2025. The other one on the other side of it is what's known as FDII. So FDII is a deduction that essentially rewards US companies for exporting goods and services from the US. So essentially, it's if you have a US company that has its intellectual property in the US, and you are, for example, an export-focused business. So again, if Congress does nothing here, that benefit shrinks after 2025. So it would mean that it would actually make the US less attractive for IP-heavy or export-focused businesses. So that's kind of the lay of the land. That's kind of where we are today in terms of the reason why there's concerns and there's an impetus there for the US legislators to pass tax legislation. We're expecting tax legislation because these are some of the big headliners of what's set to expire and sunset. Now, we have some news, and that is news as fresh as what's coming out from yesterday. It's the new House Republican tax package, and this is essentially what's known as the Big Beautiful Bill. And what this is on May 12th, we saw a little preview of it, by the way, last Friday, and then yesterday we got the full 400-page tax reform package, which is what the House and Ways Means Committee dropped yesterday. It's pretty bold. And it is being called by President Trump as the Big Beautiful Bill because, it's going to shape up to be probably, the most ambitious tax effort since the original Tax Cuts and Jobs Act in 2017. And, I think, with a name like that, and also what you'll see what's in there, we're going to talk about some of them. I think what the administration is trying to do is really lock in the Tax Cuts and Jobs Act legacy and deliver some new tax breaks. So let's talk about what that means. What does it mean to lock in some of those temporary provisions permanently? Well, the heart of that document really talks about how do we make those provisions permanent starting in 2026. So some of the changes that we're seeing in there that they're in that bill is individual tax rates. They're going to stay put. Top tax rate stays at 37% for joint filers. But that deduction we talked about, the 20% deduction for pass-through entities, they're looking not only to make it permanent, but potentially to bump it up from 20% to 22%. So that's a higher tax break on pass-through income. There's also language there around the estate and gift tax exemption to go from 10 million to 15 million, and that's for tax years after December 31st, 2025. On the international tax front, the bill definitely keeps the US in the game. So with the FDII deduction we talked about and the GILTI rates, they want to preserve them at the current rate. So they will not change at the end of 2025. And essentially what that means is they're going to keep the US market a competitive market, competitive with the OECD's 15% global minimum tax rate. Because if they do nothing to change the GILTI and the FDII rate, so they're not set to go up for GILTI and go down for FDII, that means your foreign income is essentially getting taxed effectively at 13.125%, so 13%. With the BEAT regime, that sticks around at 10% or 11% for financial institutions. So that means it also isn't rising up to 12.5%. Okay, those are some of the international provisions, but there's also fan favorites that are back from Tax Cuts and Jobs Act. One of them is the bonus depreciation. So the language in yesterday's bill talks about 100% bonus depreciation. And the other one that actually, cross-border tax advisors, US tax watchers, we've been looking for this and we haven't seen any changes to it, but we did see it in yesterday's draft, is the immediate expensing of research and development expenses under Section 174. This is actually pretty critical, guys. This is this is going to give you immediate tax relief. Now, just to give you an understanding of where we're at today before, this does actually get legislated and goes into law. As it stands right now, if you are a business in the US, you actually have to capitalize all your research and development expenses. And so what that means is when you're capitalizing your R&D expenses, that means you have to amortize them, you recover them, not immediately, not in the year you incur them, but actually over the life of 5 years, if you're doing your R&D expenses in the US, or 15 years if you're performing those R&D activities and expenses outside the US, let's say in Canada. So you can imagine, with as the law stands right now with R&D expenses, if you are forced to capitalize it, there are certain industries like the tech industry or the biotech industry, where R&D is a pretty key component of their cost structure that they've been looking for a long time to lawmakers and saying, hey, we want you to reverse this. We think this is not encouraging innovation in the US. So this is a really positive development to see that they're going to offer this immediate tax relief with R&D expensing. The other one, which we just talked about earlier, which is the interest expense limitations. It looks like the language in yesterday's 400-page draft does talk about going back to the EBITDA in terms of the interest limitation. So that means, there's going to be less of a limitation. There's more of a base for how you're able to deduct the interest expense for businesses. Now, there are some fun ones in there. Again, this is where it gets interesting and a little flashy. We'll see where this all lands in the end. But, there's language also last night around, overtime pay, tips, and car loan interest, being temporarily excluded from taxable income all the way through 2028. We know lawmakers, they also wanted, and you probably hear a lot about this in the news, they wanted to make Social Security income fully tax-free for seniors. They couldn't quite get that through Senate. So part of the language we see yesterday is they settled for giving a $4,000 deduction as a compromise. The other one you see throughout the draft bill from last night is there's going to be a new savings vehicle. And Atif, this may sound very similar to something we have in Canada, but with a different name. So it's the language used yesterday calls this a MAGA account. So this is short for Money Account for Growth and Advancement. And essentially what this is with a MAGA account, parents can contribute up to $5,000 a year for kids under 8. And government automatically also puts $1,000 in for babies born between 2025 and 2028. And then add to that, there's also a boosted child tax credit, so language around that. So it goes up to $2,500 through 2028. And then one final one I'll just add in here is, there's language to allow for a new charitable deduction for those of you who are non-itemizers. So if you take the standard deduction, you're still going to be allowed this opportunity to take that charitable deduction. So there's, just stepping back, that's a lot. That's, and again, this is just some of the highlights from that document of what we could see in terms of changes in U.S. tax. But if you've been tracking some of these changes we're talking about, a lot of it is, we talked about a multi-trillion-dollar tax increase on Americans if they do nothing. But how are they going to fund this? Like, how will the U.S. be able to provide for a lot of these, great tax cuts? We're talking about right now a nearly $5 trillion price tag. But here's the thing: the bill does include some different types of targeted tax hikes that were in yesterday's draft. So some of the ones I'll talk about here real quick are, if you are a private college with big endowments, there's higher taxes on your investment earnings. If you're a highly paid exec, there's language where companies want to be able to deduct on the really high salaries. And then if you are a private foundation or a non-for-profit or even a pro sports team, you might be facing some new taxes or lose some tax breaks. And then the last one is if you are sending money abroad, there is a 5% tax on those type of remittances. The final one we see, and this has been anybody again who works in U.S. tax has seen the headlines on this and the controversy back and forth, but the employee retention credit, it looks like they are looking to close the window for good on this after January 31, 2024, as part of a broader crackdown on the abuse with these ERCs. The other one I put this on the slide, but it's again because this is one that gets a lot of news and buzz, which is the state and local tax cap, the deduction that you get. This is, to be frank, this is still a political hot potato. It's probably one of the most controversial pieces that's been debated and made it through the draft bill here. And the proposal in yesterday is to raise the cap from $10,000 to $30,000, and then phasing it out once your income goes above $400,000. I put a question mark on there because this one really probably is still very much in flux. And then finally, the bill from yesterday does roll back a number of clean energy initiatives. And those clean energy initiatives were ones that were legislated from Biden's Inflation Reduction Act. So these include things like the low carbon energy loans, EPA climate programs, and grants for underserved communities. So a lot of rollback of these clean energy initiatives means the programs get less money, and there's, fewer loans for those type of clean energy projects. The important thing here, as a takeaway, we did I would say that was a, bird's eye view of the document and some of the changes that are coming our way. I want you to remember this. The bill that we are seeing from yesterday, the big, beautiful bill, it's not final. But what it does do for us working in the cross-border tax space is it gives us the clearest signal of where the U.S. tax policy is headed. There are certain things that didn't make it on there. For example, there's no mention of the federally designated freedom cities or the ultra-low tax manufacturing zones in economically distressed areas, which we'd heard about during the campaign promise. They also didn't bring back DPAD, which is Section 199. This was repealed in 2017. And essentially, what DPAD did is it allowed manufacturers to deduct 9% of their U.S. production income. Now, while they didn't actually reinstate that by name, I will say, though, when you look through the language of the bill, it does offer a lot of targeted and accelerated expensing for manufacturing investments. So we may actually still be leveling the playing field by providing incentives to manufacturers. There also seems to be no language to change or adjust or repeal the 1% stock buyback. This was an excise tax that was also introduced. Biden wanted to increase it. There was talk about Trump reducing it. We didn't see any language on that. So there are certain things in there that did not make it in yesterday's draft. And I think with that, we're going to go into our first poll. Atif, do you want to, we'll talk through this. So this is under the current enacted U.S. tax law, which benefit, again, assuming nothing changes, this is just a draft bill, we don't have anything in law yet, which tax benefit is being gradually reduced each year until it hits 0% in 2027? Corporate tax rates, do we see those going down to 0% in the U.S. by 2027? Bonus depreciation, R&D expenses, or not applicable? I will say, Atif, there was some talk, which was interesting because I think it played into both the economic and political landscape, whether or not the U.S. would reduce its 21% rate from 21 to 15% or even 20%. We didn't see any of that language right now in this draft bill, which is interesting.
I guess there's not going to be one thing they want to avoid is across North America is the competition to the bottom of the corporate tax to attract business or to help businesses with the margin. I guess that wouldn't make any sense.
It was, I would say, it was probably one of the biggest changes, though, was going from the graduated brackets for corporations in the U.S. to this flat 21%. But that really isn't a temporary provision. So, okay, looks like a lot of the answers coming in. Bonus depreciation, that is the correct answer. Thank you. All right. So we saw the draft bill come in yesterday. I want to talk about just legislatively. How does this work? So we see a draft bill as a business in the US or Canada, or business owner or an individual. What does this mean for me? When will Congress actually pass this bill? And, why does the current process move the way it does? Let's look at the Congress. Like, how does the Congress work? Well, again, we said if they do nothing, if nothing happens, then a long list of those provisions we talked about from 2017, essentially, they would simply just expire at the end of the year. So things like the pass-through deduction, bonus depreciation phasing out all the way to zero at 2027, and even some of the individual tax breaks. So what they can do is pass a single comprehensive tax bill. And essentially, that is what we are seeing right now with the House Ways and Means draft that was released last night. So one single comprehensive tax bill. Alternatively, they could separate that bill into multiple components, although that would make the legislative math a little bit harder. So how do we go from what we saw yesterday as a bill to what becomes law in the US? Well, it has to pass both the House and the Senate, and then it's got to be signed by the president. So let's break that down. So in the House of Representatives, we're going to do a little bit of math. The House of Representatives has 435 members. You need, of those 435, 218 votes to get to a majority. 218 to get to a majority. Republicans currently hold 220 seats, which means they can pass a bill in the House, but they really don't have a lot of room for internal disagreement or dissent. That's the House. Now let's go to the Senate. So over in the Senate, things are a bit more complicated. We have 100 senators, and under the regular rules to pass, legislation, from that 100 senators, you need 60 votes to overcome what's known as a filibuster. For my Canadian friends, essentially what a filibuster is, it's a procedural move that allows senators to block or delay a vote. So of that 60, to overcome the filibuster, Republicans currently hold 53 seats. So they actually fall short of the 60 vote threshold. And that's why Republicans are planning to use a process known as the budget reconciliation. This is similar to what we had, how we got the Tax Jobs and Cuts Act. The budget reconciliation, it's a special rule that allows tax or spending bills to pass the Senate with a simple majority, just 51 votes, without needing to overcome that filibuster. But it does come with strings attached. So the bill must directly affect revenue, spending, or debt, and it can't increase the deficit outside of the 10-year budget window. That's known as the Byrd Rule. So here's what Congress needs to do then. They need to adopt the budget reconciliation instructions. They then need to pass the tax bill through the reconciliation, and they can do it using only, the Republican votes if they needed to. And then finally, President Trump would need to sign the reconciliation bill into law. This is the path that is being used right now to get the House's tax package through before the July 4th recess. And with that, we're going to polling question number 2. This is a survey of kind of where you're at. So with these key tax provisions in the US, a lot of them expiring in 2025 and after, and there's some major policy shifts, as you see on the horizon, how prepared is your business to respond? A, we've already modeled this out. We have multiple scenarios and we're actively planning for it. B, we're monitoring, but we haven't run any tax impact models yet. C, we haven't started, but we know we should. And D, not applicable. We don't actually have US operations. Atif, I would say from the Canadian businesses they are working with, where would you say some of the questions come in for this? Have they started to model it out, or where are they at in terms of planning for it?
think it's somewhere in the middle, I would say.
Yeah.
Uh,
I think, what's critical there is, there are ways to model this out and plan and be agile for what could be coming in the pipeline for the next few months. It's, looking at your structures, revisiting your transfer pricing strategies, looking at how things are being priced from a tariffs perspective. There are many opportunities to plan for this and be ready for it. Looks like we've got similar answers from our audience here in terms of we're not monitoring. We're looking at tax impact models yet, and some of them haven't started, and some are not applicable at all. Atif, maybe you can walk us now through some of the recent tax reforms in Canada.
All right, thank you, Namir. So there's nothing big, beautiful, or bill here. Most of these have become, they have been royally assented, so they're legislations. Digital services tax has been went through the royal assent last year. So if you are caught by these rules, you will need to file a digital service tax return by the end of June 30th, 2025. And who are caught by the digital services tax? Essentially, this tax targets those companies which are making money from the Canadian consumers, the Canadian users. And the companies that are caught are the ones that have a digital revenue, and they are part of the consolidated group with digital revenue of $1.1 billion. And they're part of their Canadian digital service revenue exceeds $10 million. So if you're caught by these rules, you will have to pay the digital services tax and meet the filing obligations. What does the digital services revenue mean? Essentially, it has been defined as online marketplace service revenues, online advertising services revenues, social media services revenues, and user data revenue. So this is a new legislation that has come in, and we will be doing the filing for it in 2025. So keep an eye on it. If you are caught by these rules, you will have to pay the tax and you will have to do the filings to meet for it. The second one that has received royal assent was also in 2024, 5% global minimum tax for large multinationals. So it came from OECD, which had this project where they discourage or prevent, to a certain extent, companies from transferring their revenues and expenses from one jurisdiction to another to pay lesser amount of tax. Now they have come up with this idea of global minimum tax. So you will have to pay 5% of global minimum tax if you are a large multinational corporation. Again, who is caught by these rules? If you have a part of a group, multinational enterprise with $750 million or more, 750 million euro, which translates to 1.1 billion Canadian dollars roughly. If you have that kind of revenue, then reported on your consolidated financial statements by your parent entity, then you're caught by these rules, and you will have to file one of the forms that is required under this legislation. So something to watch out for if you are a big multinational corporation or if you meet the test. The general anti-avoidance rule has been tightened to prevent aggressive tax planning. If you must be familiar with general anti-avoidance rule, acronym GAR. Essentially, it came in decades ago, introduced in Canada, where those entities that were using the Canadian legislation, tax laws, to come up with plans to save taxes. Now, the letter of the law might not have been violated, but the spirit of the law was violated. The reason the policy was in place was to prevent this planning, but someone came up with this creative idea that why don't we do it this way? That way we are not violating the letter of the law. And then Canadian government introduced GAR. Now, there have been a lot of court cases, and there has been a lot of discussions over this. CRA, when they come up with a new law, that means that the courts is generally, arguably favoring the taxpayers, at least as they perceive it. So they came up with new GAR rules, and now in 2024, I believe, that said that if you are deriving a tax benefit, now under the old rule, tax benefit was one of the reasons for being subject to GAR. So if you're caught, if you have a tax benefit, and there were a couple of other conditions that need to be met, you will be caught by GAR. Now they have come up with this idea. How do you determine tax benefit? Well, you look at the economic substance as well. If whatever transaction that transpired had an economic substance, it was for bona fide reasons, but it also had a tax benefit. But the main reason, high level, was economic bona fide reasons, then you could avoid GAR. So now the CRA, or the Department of Finance, has tightened or broadened the definition, of economic benefit. So if you have a legislation under the new laws, under the new legislation, if you have violated the spirit of the law, but you can try to demonstrate that you were doing it for bona fide reason, you can get caught by these provisions. The rules have been tightened, the rules have been made more strict, and the normal reassessment period has been extended by 3 years, and there is a 25% penalty on the tax benefit that you derive from it. The idea is that if you have been carrying out these tax plannings, make sure that you look at the GAR and the capital gain strips that has been part and parcel of some of the tax plannings in the past few years. Most likely that is now out, is GARable, considered GARable by the CRA. So watch out for that. Capital gains reform and exemption. I think this has been already talked about in the last couple of months, that the Trudeau government had introduced the idea of higher inclusion rate, but Carney has reversed that. Now we have a polling question after this. So this polling question refers to the slides that I had talked about earlier, the tariffs update. The federal government of Canada will consider requests for remission in the following instances: remission of the tariffs to address situations where goods cannot be sourced domestically or reasonably from non-US sources. Exceptional circumstances considered case-by-case basis, available for auto sectors only, or one or A and B. It should say A and B, it says 1 and 2 there. So choose A and B, or A, B, or C. We'll give you guys a little bit of time here to think it through and answer, and then we will discuss it. And again, keep in mind that there were 2 series of tariffs. There was a March one where they came up with the relief, and then there was the auto sector tariffs came from the US and Canada responded to it. And so there were 2 series here, and we are talking about, maybe I shouldn't say that, that will give away the answer. Okay, the results are 1 and 2. So that's 75%. That is the correct answer. Auto sector relief came later, and it is, as I was saying earlier in one of the slides, that relates to if you are making a car in Canada, and if you keep the production up in Canada, and if you are allowed to import cars from the US with a relief from tariffs. That was for the auto sectors. But initially, the first 2 points came when the initial tariff was imposed by the US and Canada responded, but it said that under certain circumstances, you can be given a relief, or and those circumstances being that you cannot source your product anywhere else other than US. Okay, and
Atif, we sorry, real quick, we actually just got a question from the audience here, so I'm just going to read it real quick.
okay.
As always, this is the question. As always, if Canadian business owners looking at cross-border taxes, do the announcements from yesterday, I'm assuming this is referencing the US draft bill, make Canada more or less competitive to a business owner? I think the short answer there is essentially it does make Canada less competitive. What we are seeing in that draft bill is there is definitely a focus on businesses. There's also a focus on domesticating businesses. So any manufacturing that's happening. So focus on businesses and a focus on manufacturing. There's the 100% capital expensing. So a lot of it's incentives to essentially have businesses onshore their production to the US. So I think, in short, it does make Canada less competitive, and they'll have to find ways to respond to some of the draft legislation there.
Okay, thank you very much. That was a good, fair question. That's one of the discussion that has always been there, and now will be more so given the tariff environment we are in. Moving on to EIFEL and interest deductibility. And thin capitalization rules are not new rules. They have been around before. I'm pretty sure you guys are aware of it already. But just to give a context to EIFEL rules, and EIFEL, again, has nothing to do with Eiffel Tower, even though Namir chose to put Eiffel Tower there. With
I couldn't resist. I'm so sorry.
No, this is very good. I love the moose there. It's a Canadian Eiffel. Anyways, so thin capitalization rules are essentially what it says, thin capitalization. So if a foreign company is putting a thin capital into Canada, then certain amount of interest that is leaving Canada to that lender will not be tax deductible, and you will have to pay tax on it. Now, how is that determined? Well, you look at the loan amount, you look at the equity amount, and you do some calculations. And if there is a threshold ownership of a foreign entity that is met, then the rules kick in, you do the calculations, and you determine how much tax is non-deductible. Now, if that interest is non-deductible, then that particular interest is not caught by EIFEL because that has already been denied deduction. But whatever is left over is open for EIFEL analysis. So how EIFEL analysis works is, it is exactly what it is and what it says: excessive interest in financing expenses limitation. Now, how it works is that if you're looking at your financial statements, and first of all, it's the impacted parties are corporations and trusts. And so if you're looking at the financial statement and you see an interest expense there, and then you should be considering EIFEL rules. However, IFE, interest financing expenses, is a defined term. So it includes certain other expenses as well that you need to be aware of. And if you are caught by EIFEL rules, then you take that interest expense, you look at your interest revenue or financing revenue, interest and financing revenue, you look at interest and financing expenses. So 21 sub E is also part of the calculations, just trying to give you a taste of, it's not just expenses and revenues. Other elements in the balance sheet or income statement can be considered as well, or in the Schedule 1. So you take your interest expense, and now you have to figure out how much is caught by EIFEL. So you calculate your taxable income, adjusted taxable income, as they call it. So you take your taxable income, you add back the CCA, make some other adjustments, and what happens is that you have an adjustable taxable income, and then you multiply it by 30%. In some cases, 40% if you're fall within the domain of transitional rules. And whatever you take, a number you come up with by multiplying adjusted taxable income times 30%, that's the amount that you can deduct. So now there are certain reliefs available. If you have another entity in Canada that has lower expenses and more revenues, you do the same calculation with them, and you see if you can transfer some of the excess capacity of that interest deduction to your Canadian party, which is caught by the EIFEL rules, and they can't deduct their interest. So something to watch out for. And there are, in some cases, you can go back past 3 years and do the pre-regime capacity. Basically look at your entity from in the past years and do the same calculations using 40% using 30%, 40% of the transitional rules, and see if you can carry forward some of the capacity to the current year. So you have to fill out a Schedule 130 that is due along with the tax return. Now, if you are going to tap into the capacity of your other taxpayers, other corporations, related parties, then you have to, if you're tapping into there, you have to make the election to do so. And that election has to happen at the time of the filing of the tax return. Now, if your tax year end is December 30th and you have to file in June, you still have time to do the analysis and make that election. But if you've already done the analysis and you have already filed the return, and the return will, let's say, was due in March 31st, 2025, then the election will be late. However, there is a provision which says that you can ask the minister can give you a break because these are the new rules. These are very convoluted, complicated rules. The minister can also give you a break on that. Now, carve-outs are, if your business is substantially Canadian, then EIFEL rules do not apply. What is the substantially Canadian? Again, that's a defined term. One thing to watch out for, if your Canadian company owns a foreign affiliate and its fair market value of book value assets, or fair market value of the asset or the book asset, if it exceeds $5 million at any time in the year, then you are again caught by these rules, even though you might think that you have a substantially Canadian business. So these rules are going to be they have been brought into effect. A lot of people are struggling with it. A lot of people are trying to figure out the rules because they can get very complex in some situations. Now I think we have a polling question now. So EIFEL rules apply to the following taxpayers: corporations, trusts, partnerships and corporations.
I thought it's interesting because, sorry, I was going to say just, with the EIFEL rules, we've got that 163J comparison.
I was going to ask you the same thing. Is it similar to the US ones?
Well, and sorry, say that again.
Is that Canadian rules are somewhat similar, high level to the US?
Well, what's interesting is with the draft bill from last night is where they're going back to is 30% of the adjusted taxable income of EBITDA. So there's actually almost less of a limitation. But we used to actually have the thin cap rule of the 1.5 debt equity ratio. And that was done away with in 2017 to go to what we have now as 163J. And so instead of keeping a debt equity ratio to see how leveraged you are, to what it seems like that's what we're seeing here on the Canadian side, now we have not just in Canada, we have not only EIFEL, but you have thin cap too. So it seems like Canada is going to have more like a belt and suspenders in terms of interest expense limitations.
Maybe they'll get rid of thin cap down the road. Maybe they want to see how these rules play out. Yeah, that's a good point though.
And that applies to related and unrelated interest. Is that right?
No, it can apply to related interest as well in some cases. But we'll talk about that maybe next presentation. So the answer is corporations and trusts. So most of you did get it right. Sometimes the partnerships are caught in the structure if they're part of the corporate structure, but those rules, we're not going to get into it. They need more time. Hey, so strategic planning opportunities. As I think Namir already touched upon some of these in detail. If you are in manufacturing, move operation to the US. And if you are providing consumer goods, maybe move distribution channels to the US or distribution setup. Managing supply chains. Now, a lot of businesses have been struggling with the idea of supply chains when the globalization kicked in a few decades ago, but now they are reevaluating their supply chains strategies. Some of them are thinking of setting up supply chains in multiple countries so that to mitigate the risk. They might reduce the margins, but it might save them from a pain if one or two jurisdictions they operate in come up with their own tariffs. So they're diversifying their supply chains by setting it up into different jurisdictions. I'm not an expert in supply chain. I believe that's called modular supply chain, Namir, am I right?
That's right.
Heard about that. And then there's a transfer pricing planning where transfer pricing, as you know, is a payment that happens between intercompany across the border related parties. and they are allowed to, you can charge a certain amount of revenue from your US company or Canadian company, depending on which jurisdiction you're operating in. Now, a lot of analysis goes into transfer pricing. So when you come up with the transfer pricing, it could be a royalty, it could be management fee, it could be bundle of all those things. So some of those things, such as management fee, for example, might not be as impacted by tariff as some other piece that goes into the transfer pricing analysis. So unbundle your transfer pricing analysis and revisit it. I'm not an expert in transfer pricing, just giving you a high level. And then aligning tax strategy with business strategy. At the end of the day, your business should determine the tax strategy, even though the tariffs have impacted directly the revenues. But having said that, at the end of the day, don't let tariffs guide your business. The businesses at the end of the day should be driving the tax planning.
That's absolutely right. Yeah. I mean, and I would say add to that, Atif, revisit the strategies that you have. If you had your structure set up, a while back, if you had it set up, before the Tax Jobs and Cuts Act, or you've had a transfer pricing study that's been around for a few years, any one of those things, I would say, revisit those strategies, revisit your cross-border structure, look at how efficient it is. And, there are ways to be able to plan through these uncertainties and these changes. And of course, talk to your tax advisors to help you plan for it, and model these things out. There's ways to model out proposed changes and current state to really build a roadmap for setting your business up for success, for doing business in the U.S. As a Canadian entity and as Canadian business owners. With that, we just want to thank everybody for tuning in for this morning hour on all things cross-border tax in this protectionist U.S.-Canada landscape. We did take a few of your questions. If there are more, please feel free to send it our way. We're happy to follow up with you. And again, you will get that survey. So if there are any additional questions or any additional topics you'd like for us to explore, we will follow up with you. We love hearing what topics or what issues or questions are top of mind for you. So please do reach out. And again, thank you for attending.